Hey, Steve Saretsky here. As always, the Canadian real estate market update with a particular focus on Vancouver. If you're getting sort of value or entertainment out of these videos, all I ask that you hit thumbs up and subscribe. Questions, comments, put those below. Quick bit of housekeeping. The Saretsky report for September 2019 is now available, as it is every month. So if you haven't read it or checked it out, there is a link below in the description to the full PDF, 20 some odd pages of detailed analysis on the Vancouver housing market. So enjoy, it's free. Quickly to touch on the Vancouver housing market, we did a little bit on it. I'm just going to touch on it briefly before we get into bigger things. But yeah, basically the market activity has undoubtedly, no question, picked up. I think it's a market that is really trying to figure out the direction that it wants to go. Prices are all over the place. We're seeing multiple price reductions, prices dropping in some segments, and then we're seeing multiple offers in others. So very, very much all over the place right now. I don't think we're going to get a clear direction until later into 2020, the start of 2020. Hopefully that will provide some more context. I don't think you're going to see much change in the next few months. But what I will say is basically has shifted back to this local end user market. The people that are buying today, the people that are active in the market are local end users looking for primary residences. The investors have stepped back, the speculators have stepped back, and the foreign bid, particularly the Chinese bid, has vanished. So all you have to do is look at the number of homes being flipped in Greater Vancouver. Housing activity has collapsed more recently over the past year or so. So I think this kind of goes to show you that, again, local end user market. But I think if we're going to talk about the future direction, we need to also talk about what is happening again from the larger context. The Fed, the U.S. Federal Reserve, has once again announced the start of quantitative easing, QE. They're saying don't call it QE, but it is QE. They are agreeing they're going to start as of October 15th. The Federal Reserve is going to start purchasing $60 billion of U.S. Treasuries per month. And so, the remaining schedule looks like they're talking about into the beginning of 2020. This is basically a function of them trying to prolong the cycle. This is them 10 years into an economic expansion, seeing asset prices starting to come down, seeing the manufacturing and services sector slow down, and they're trying to prolong the cycle, obviously with rate cuts globally, but now the Federal Reserve trying to step in and ultimately try to weaken the US dollar to prolong this and keep asset prices levitated. So obviously, certainly bullish, I think, in the short term for what this may do, but I think what I'll sort of explain in this video is just because you do quantitative easing does not necessarily translate instantly into, say, higher asset prices, or actually more realistically is growth in the economy. So what you'll see is, as we've seen in Europe and Japan, is just because you drop interest rates to zero and you engage quantitative easing does not mean that you're going to get growth out of that and that's going to propel you out of a slowing economy. We've seen 10 years of stagnation, actually 2 decades of stagnation in Japan. What they need is a transmission mechanism. So there's a number of ways to go about this, and so the video is basically going to try to explain that. If you want to understand how you get higher real estate prices, you need a transmission mechanism into the market, and that transmission mechanism is residential mortgage credit growth. It is commercial banks, i.e. RBC, CIBC, issuing new debt, i.e. new mortgages, into the private sector, which allows the growth in home prices. So there's a couple things for that. You need low rates are certainly one thing, but just because you have low rates, that doesn't mean a bank still has to decide, a commercial bank has to decide if it actually wants to lend out those excess reserves that are created through quantitative easing, or what is the outlook? Is the profit margin worth the squeeze for the commercial bank? And lastly, the consumer, who just because a bank hands you a loan on a silver platter, the consumer has to have a desire and a willingness and a confidence to borrow that money. So obviously if their job is insecure or unstable, or they're not sure about the economic outlook or the outlook for home prices, a lot of people will just sit on the sidelines and choose not to borrow money. And same thing for banks, right? If they still see real estate prices are coming down, the economy is uncertain, then the commercial banks might not necessarily issue new debt. What we can see in Canada is because of the regulatory framework, i.e. mortgage stress test, Bank of Canada hiking interest rates, etc., what we've seen is residential mortgage credit growth collapse to multi-decade lows last year. So residential mortgage credit growth was growing at its weakest pace in 2 decades, hence why we had sort of the drop-off and massive deceleration in national home prices across Canada. What we've seen over the last 4 to 5 months is a re-acceleration of residential mortgage credit growth. Now, again, it's coming off multi-decade lows, so it's some context there, but what we can see is residential mortgage credit growth is growing, though it's a sign that consumers are starting to borrow again and banks are obviously lending that. Now, the other thing to understand is commercial banks, and this is probably my largest pet peeve, is commercial banks. You have to understand how commercial banks function. They function like an investor. They have mandates that they need to reach, and they stems from the top. So they look at it and say, okay, well, which markets are hot, which markets are frothy, which markets are balanced, which ones do we want to lend in, and which one are the regulators asking us to lend in. And so it was funny because what we saw was, Vancouver sort of implemented this foreign buyers tax, and then sort of Toronto real estate prices started going up, and then Toronto implemented theirs, and Montreal went up, and then Ottawa went up, and then Prince Edward Island went up. And people were like, whoa, like the foreigners, the Chinese are laundering their money. They're going from Toronto to Montreal to Ottawa to Prince Edward Island. But they're leaving Vancouver, and they're leaving Alberta, and they're leaving Saskatchewan. But what you need to understand is this is not a function of foreign buyers, okay? So Chinese buyers are net asset sellers globally in 2019. So they're not miraculously putting money into Montreal and Ottawa. They're not saying of all the places in the world to go and put my money into, whether I want to put it into a business or commercial real estate, I'm going to pick residential condos in Montreal and Ottawa. That's not the case, okay? What happens is banks shift their lending pool around. So banks will begin, if they see weakness in the Vancouver housing market or policies that come in that they think are going to impact the Vancouver housing market, such as foreign buyers taxes, empty homes taxes, etc., they will then say, oh, well, Vancouver looks risky. Let's diminish our lending portfolio in Vancouver. Let's slow that down, and let's begin allocating it in Ottawa, because Ottawa seems like a stable market. There's relatively strong job growth, wage growth. Home prices are still relatively affordable, so there's not going to be that kind of volatility. As a bank, it would logically make sense, and I can affirm you 100% that this is how banks function. It doesn't take much. All you have to do is not only research of it, but talk to the people that are actually issuing all the debt and executives in the bank. Okay, so you need to understand that mechanism. So it's funny to me is that people sort of extrapolate. They need to simplify this because most people don't understand banking. They just assume that the foreign money has gone to Montreal condos and Ottawa condos, as if foreigners have nothing else to invest in. But I think that's an important context to understand lending. So to bring that all in, what does that all mean is, again, this comes down to the strength of the labor market. It comes down because households have to have jobs to borrow money, and banks need to see a creditworthy consumer to lend money. So just because we start engaging in QE and bring rates to zero, as I said, was going to happen, it's irrelevant because asset prices are so levitated and the economy is so dependent on higher asset prices that it is inevitable that the only way out for central banks is to lower rates to zero and engage in basically massive quantitative easing. We've already talked about modern monetary theory, which is essentially monetizing all the debt in the world, essentially, particularly government debt. So I think at some point that's going to be highly inflationary. It could be a year from now, it could be 5 years from now, but at some point we'll get there. But this is kind of the start, I think, of what we're seeing as the Fed is they've run out of room. You've cut rates, you're going to keep cutting rates, and there's still issues in the repo market, and we've hit the zero bounce. You need to restart the quantitative easing game. Again, I'm kind of curious to see how this all translates into the local markets. You can talk about Canada, Vancouver, but I think that's so small, almost on a larger sector or segment, that here we are again, never can get out of quantitative easing, can never get out of zero interest rates. You've continued to pile on the debt, and so I don't know where we go from here, but I think that we're watching with pure amazement. And as always, every week we'll update you on my thoughts and things that I think are important to the market, to hopefully educate, and people can make their very best decision, whatever that decision may be. Anyways, that's pretty much it. Happy Thanksgiving. Enjoy your long weekend. See you next week.